Good morning, everyone. Welcome to this update for global stocks and commodities for the 17th of March. I've titled this edition this week, Let the Market Come to You. And I mean, that's always an important way to attack the market. But I think particularly even more so at the moment when markets just keep going up and up, particularly in the States. And if you're not fully invested, the pressure seems to build that you feel like you need to do something with your money and you need to chase the market because you're missing out. This is the time when the indices have been running up. I think it's 10 of the last 12 weeks the US market has gone up. This is the time when you really need to sit back and just wait and really do very little and let the market come to you. So tactically, that's the approach that I think is important in the short term. So let's jump in and have a look at what happened in the last week. It was really just a continuation of recent trends and sentiment. So there's not a lot that I can add this week to what I said last week. And I hope that you were able to view the additional special weekly or intra-week video that I did, which the purpose of that was because the Australian economy is really heading rapidly in the wrong direction, and that is going to impact the top 100 stocks in particular quite badly, and stocks that are highly reliant on the health of the Australian economy to do well. And so the purpose of that special video that I only do once every blue moon, really, I hadn't done one for a couple of years, was just to provide investors with the confidence to pursue the great growth opportunities that there are in Australia outside the top 100 stocks. There really are some tremendous opportunities, not a heap of them, but there are some. And there's two aspects to that. You need to know how to find them and tactically how to play them, but you've also got to have the confidence to pull the trigger when the media backdrop is quite negative. So I hope you had a look at that. If you haven't, then try and find it on YouTube. So today it's really just a matter of not trying to second guess the market. Just stay focused on what is. Our mind can play tricks on us, and particularly the fear of missing out. I find is a really strong influence on a lot of people, and you just got to really try and get past that and just be prepared to wait and let the market come to you. Know what stocks you want to buy. Know broadly what sort of price or level of pullback is appropriate, and just wait. And that's the best way to play markets that are doing what they're doing at the moment. There'll be the normal stock and commodity trend update, of course, and Portfolio Analyst last week. I covered Australian gold stocks, 5 or 6 of the main producers, and also I went through my highest personal stock weightings in Australia in my super fund. So I think members found that useful. So let's look at the American market. The S&P was up very robust 80 points, nearly 3% for the week. So that was after a 1 week pause. It turned around and shot up quite strongly. Had a little peak above the resistance level, as we'll see, and then finished right on it. So in the US, it's continuing signs of strength and confidence in the market, and certainly the sentiment has just turned around so dramatically since the Fed capitulated at the end of 2018. So buying the dips in the States remains a valid stance. First of all, you've got to have stocks that have got really strong fundamentals. Secondly, they've got to be at or below fair value. So they're the two precursors. And then if you can buy them on a dip, then it's a pretty productive and low-risk way to go about things. The US dollar down slightly last week. I think that was a little bit about the British pound going up a bit as well. The 10-year yield, however, continues to drift down. We're now down under 2.6, and if you remember, it was only A handful of months ago, we were trading at 3.25, and everybody thought that 4% was an absolute done deal. And now it just continues to drift down in the opposite direction. So let's take a look at the US market. So we'll start with the S&P, and you can see there are three key resistance levels. The first one was the highs from October of 2018, October and November of 2018. We managed to get back to those levels. In March, had a little pullback that really didn't even last a week. It was really only 3 or 4 days, and then straight back up again. We've had a little peak above that resistance, not that it's in any way definitive, but at least the market was able to regain strength again. So what I read into this is that we only had 3 or 4 days down. We didn't have multiple weeks, so that's a sign of strength. We didn't pull back very far, so that's another sign of strength. And if we put a Fibonacci retracement scale on this, you can see that even if we pull back to around 2636, that would have still been deemed to be quite a robust uptrend. We didn't get anywhere near it. We barely got to halfway. So that's the second sign of strength. And then the fact that this has gone up so quickly. It's basically taken back those 3 or 4 days of losses in basically 3 or 4 days more. So looking really strong. You'd have to say that the assault on the January 2018 highs, which was at 2870, you'd have to say that now looks to be the path of least resistance. And then we've got the all-time highs at around 2940, and the way it's going at the moment, you'd be very brave to bet against both of those levels being challenged in the near term. So that's the US market, and of course the Nasdaq and the Russell, they all look pretty much the same. US dollar still got a little bit of an upward bias to it. We are getting short-term higher highs and higher lows, but we were back down to the bottom of that trend channel during the week. The Australian dollar is really going in the opposite direction. We've got a wedge forming here that's got a downward bias to it. It's got a flat base and a downward sloping top to it. So one would think that the odds favour the Australian dollar breaking 70 cents. Okay, so our dollar rose just a little bit, and it was really just about the cross rates with the US dollar. But there is increasing pressure now on the RBA to cut certainly once, maybe twice this year. I think that looks highly likely. And if the RBA does cut, then you'd have to think the Australian dollar is going below 70 cents. Probably the only thing that's holding it up at the moment is the strength in iron ore, which is back up into the $80 area. And that's largely because of the shutdown of production in South America with the dam failures. But other than that, I think you would find that the price of iron ore would be perhaps $10 or $20 a tonne lower, and that could see the Australian dollar lower as well. Our index fell by 29 points on the week, despite the very robust performance in the States, so we were down 0.5%. And more data points just keep coming through. There was the NAB business survey that came out early in the week, and that sort of sent quite a lot of the top 20 stocks falling further. So it all adds up to a rapid economic slowing, and if you're pinning your hopes on the major stocks in the top 100 that are heavily tied to the health of the Australian economy, then I think you want to have extremely modest expectations about the sort of return that you're going to get. If you want a decent return, you've got to pick individual stocks. Most of them are outside the top 100, and in fact outside the top 200. And that doesn't mean that you've got to take on board a lot of risk. there really are some tremendous stories, and if you're disciplined about valuation and technically where you get in, I think you can pull off some very decent returns for probably less risk than most people take trading the top 100 stocks, to be honest, because a lot of those stocks are in downtrend. They've probably got little prospect of turning around, and every chance they're going to go further. So for me, that's the definition of a risky stock. I don't think you should feel at all comforted by the fact that it might be a top 100 or top 50 stock. That doesn't make them low risk. What makes them low risk is that they're a growth stock, they're undervalued, and they're going up. So that's how I sort of view the Australian market. So I think to achieve that, for most people, unless you're in a position where you've got the time and the interest to do the very substantial amount of research that's required, then you really need to tap into research and tactics from somewhere. And that's certainly something that I try to do in Portfolio Analyst, as I repeat each week. So let's take a look at the Australian market. Okay, so we had a dip, and that was certainly in the banks and the major miners. And it's not much of a dip, and we've still got a very, very strong uptrend that's been in progress now since Christmas Eve. But I think it gets hard work here for the Australian index. If we look at the banks, you can see that we've got a bit of an upward bias, but it's starting to lose some momentum now. And if we go to the major miners, certainly the major miners looking a lot better, and part of that is because BHP and Rio are paying out very substantial special dividends to investors, and that's certainly been one of the strongest sectors of the Australian market. All right, this is the gold price. So you can see quite clearly we are in uptrend. Let's just look at the weekly first. So we still got to get above this 1380 level. That's critical. We've had a strong rebound since early September, so we've been rebounding now for nearly 6 months. But this is the big level up here, 1380, and there's still a bit of work to be done to get up to there. Now you can see that we did have an uptrending channel. We were able to show, or the gold price was able to show sufficient strength to actually break out of that channel. So what that means is that from this point here, the upward trend in gold has actually accelerated, because it's managed to get out of the trend and started running at an even higher rate than what it did down here. Now, that being the case, you would like to see that gold didn't move back below the midpoint of this channel. So I'd sort of put that, if we want to see this continuing strength, then we probably want to see gold hold above that level. And so far, it has. So the signs for gold are still positive. Let's just look at GDX, so covering all the major miners. So this is a weekly chart. We do have a medium-term uptrend, but we need to get above this resistance level here. Very close, but just needs to get up, trade above about $24, $24.50 on GDX, and I think we'd be looking in much better shape at that point. So gold higher to just over 1302, and it's being helped by two things: negative real interest rates, and now that the Fed has capitulated on interest rates, that means that real interest rates, which is the nominal rate minus the rate of inflation, is back now down under the flat level, and the prospect of getting positive real interest rates is that much less. And I suspect there's also a bit of concern that central banks have now got waning influence. Certainly that's been the case in Europe. Their policies have been unable to stimulate their economies. It's certainly been the same in Japan for 20 years. there still seems to be a response from the economy in China and the US, but central banks haven't been able to get rates up. The Fed tried, and the market basically fell over. So I don't think we're going to see the Fed do that again. So what happens when the next recession comes along? Normally recessions start when interest rates are 5, 6, 7%. What happens when the next recession comes along and interest rates are only at 2.5 or even less? The Feds have got very little ammunition left to use, and I think more and more people are getting concerned by that and starting to just ramp up the weighting of gold in their portfolios. Precious metal stocks, as I said, GDX still in medium-term uptrend, but really does need to break out. Copper rose a little bit. I suspect that's really just about currencies. And crude oil, however, showed some surprising resilience, considering the global backdrop, the way that economic growth rates are being wound back. It was surprising to see crude back up where it is, but it's going well. There's our spot copper chart, and of course the inventory is still sitting down at close to 5-year lows. And there's our oil price over the last 3 months, quite a strong rebound from just under $44. So wrapping it all up, it's really important, as I said at the start, to stay disciplined with your plan. There is an overwhelming tendency to want to chase the markets when they're doing what they're doing. You can see that things are going well, that the indexes are going up, and there's this strong temptation to jump in and be a part of it and not miss out. You've really got to resist that, because this is just the time when markets can have several weeks where they decline. So often sitting around doing nothing and just waiting is the best plan, and I think that's pretty much the way it is at the moment. But having said that, there'll always be a few individual stocks. So if you've got your target list, there'll always be a few stocks that are presenting. And one of my very favourite stocks has just pulled back and is now back definitely into a buy zone. So the key message here is only transact when the market comes to you on your terms. And if you can continue to do that, then you should do okay. Portfolio Analyst this week is really just a matter of capitalising on some of those great individual setups. And so that's it for this week. Here's my contact details. As always, there's the $1 Portfolio Analyst trial, which is available for you to take. And I'll be back with you next week. Cheers.